International Monetary Fund spring meetings continue to be center stage in a busy week that saw a softening on trade rhetoric, with global market sentiment attempting a recovery. China, however, says it will not talk with the US unless all additional tariffs are removed. It was, like I said, a busy week. US Treasury Secretary Scott Bessent scolded the IMF, saying the IMF must be IMF again, and calling for the institutions to step back from sprawling and unfocused agendas which have stifled their ability to deliver on their core mandates. At a presser yesterday, the Managing Director, Kristalina Georgieva, repeated the need for speedy resolution of trade-related differences as the sharp rise in uncertainty is weighing on economic activity. She also said a more collaborative African continent can reap gains in the tougher and tighter landscape.
We have significantly downgraded our projections for global growth. Major trade policy shifts have spiked uncertainty off the charts, accompanied by tighter financial conditions and higher market volatility. Simply put, the world economy is facing a new and major test, and it faces it with policy buffers depleted by the shocks of recent years. First and most urgent, for countries to work constructively to resolve trade tensions as swiftly as possible, preserving openness and removing uncertainty. A trade policy settlement among the main players is essential, and we are urging them to do it swiftly because uncertainty is very costly.
And still on tariffs, China is reported to be considering exempting some US imports from its 125% tariffs as it asks businesses to provide lists of goods that could be eligible. All this as Trump reasserts that trade talks with China are ongoing. Hello and welcome to Global Business Insights, where we look closer at some of the headlines moving markets and try to join the dots to equip viewers to succeed in the marketplace. At the IMF spring meeting set to wrap up tomorrow, it was observed that financing costs in emerging economies surged in the recent market turmoil. Sovereign spreads for weaker risk-rated economies spiked up as compared with investment-grade risk, spelling higher burdens for developing countries at a time when fiscal space is tight and the additional cost burden harder to bear. Also, at an event on the sidelines of the Washington IMF meetings, the Director General, that's Nigeria Debt Management Office, Patience Oniha, noted that Nigeria was in talks with JPMorgan to be admitted back into the JPMorgan Emerging Market Bond Index as its eligibility has significantly improved. Opeyemi-Agbaje speaks on what that could mean.
I think it's a good thing that Nigeria is talking to JP Morgan about the entering the government bond index. It's in 2015. That was the first significant action that took Nigeria on the path to the economic ruin that we experienced for the next decade. It was a policy decision on whether to run our currency, the naira, in more orthodox and more, I would say, sensible ways. But we had, I think, a president who did not believe in the markets, and a central bank governor who felt obliged to do whatever it took to satisfy his boss and retain his position. So in that, I think we paid a high price for exiting that government bond, that JP Morgan index, because it started the process of excluding Nigeria from markets, seizing our inflows of foreign direct investment and portfolio investment, and signaling to the world and to the markets that we were not going to follow conventional orthodox economic policies. And therefore, nobody felt obliged to invest in our markets. Unfortunately, 10 years down the road, our currency has devalued by over and over again. I don't, somebody would have to calculate what the percentage we have suffered over the years is. And instead of taking maybe a 10 to 20% devaluation at that time, just to regularize our exchange rate and then continue to enjoy the benefits of participating in the market, we refused, and we set in a process that has seen such destruction of not just the value of our currency, but the economy itself. So I would say it's a great thing to get back into the index. It's a little piece in the process that then communicates that we're back, that we've reformed our economy, that we're doing things in a more rational manner in line with economic principles. And hopefully we can then begin to get the impact on our investments in both portfolio and foreign direct investment.
But to other stories, Wall Street extended its rally. All three major US stock indexes were higher, with a solid boost from technology shares as investors digested a mixed bag of corporate earnings and monitored progress in the US-China tariff standoff. The count of Americans filing new applications for unemployment benefits increased marginally, suggesting the labor market remained resilient despite fears of a recession. Data yesterday showed weekly jobless claims increased 6,000 to 222,000, while continuing claims declined 37,000 to 1.841 million claims. US orders for durable goods, that is items ranging from toasters to aircraft, meant to last 3 years or more, jumped 9.2% last month after slightly downwardly revised 0.9% gain in February. The surge was attributed to strong demand for commercial aircraft. Still in the US in March, the National Association of Realtors said existing home sales dropped 5.9% last month to an annual rate of 4.02 million units. Demand for houses was weighed down by higher borrowing costs, with all the uncertainty also dampening appetite. And in Germany, there was a revised growth forecast downwards to zero for this year, as it expects its export-dependent manufacturing sector to be impacted by higher tariffs. Its previous prediction was for a 0.3% rise in GDP for 2025. Germany's GDP shrank by 0.2% last year and by 0.3% in 2023. Incoming German Chancellor Friedrich Merz has vowed to reinvigorate the economy with higher debt-funded spending on infrastructure and defense, as well as tax subsidies for investment and deregulation. Morocco is moving forward with a rail expansion plan worth 96 billion dirhams, that's about $10.3 billion, which includes construction of a high-speed line to Marrakesh, the country's main tourist hub, by 2030. Morocco's preparations to co-host the World Cup in 2030, together with Spain and Portugal, has spurred extension of high-speed intercity and urban rail networks. South Africa's producer inflation, that's PPI, slowed to 0.5% year-on-year in March. That was from 1% in February. Month-on-month, the producer price index for March was up 0.6%. Now to some global earnings releases. Pepsi reporting first quarter revenue of $17.92 billion, down 1.8% from the same period a year ago, and adjusted earnings per share of $1.48 a share. Pepsi now expects its full year core earnings to be approximately flat from the previous year, having previously forecasted mid-single digit percentage growth. Alphabet, the parent company of Google and YouTube, reported first quarter earnings after the bell, beating on both top and bottom lines. Q1 revenue at $90.23 billion beats $89.12 billion estimated, and earnings per share also better than estimated at $2.81 versus $2.01 per share expected. Google benefited from steady growth in its digital advertising business, which helped offset somewhat muted growth at its cloud computing unit. Alphabet shares spiked up in after hours. For Intel, Q1 adjusted earnings was 13 cents a share, above Wall Street's consensus. Revenue came in at $12.7 billion, also above analysts' expectations of $12.3 billion. Guidance was disappointing though, as Intel provided a revenue forecast range of $11.2 billion to $12.4 billion for the current quarter. Compare that with the consensus call of $12.8 billion. The numbers are not bad, a slight markdown in many cases, but not enough to worry markets, even though guidance was lackluster. US futures were positive for most of after hours, buoyed by the latest releases. Just a few thoughts on the week. The macroeconomic data and corporate earnings and outlook in the US suggests, as the IMF has also said, a potentially sizable markdown, but not a recession. But we could still have a shallow recession, in my view, in 2025. The pickup in 2026 will depend on impact of the tax cut legislation and the deregulation trajectory, and how that plays to boost a rebound in the short medium term. I suspect the intense geopolitical divisions and strong mainstream resistance, including legal action playing out in the US, will paralyze any significant growth into the midterm elections, but we have to wait and see. Also, China is unlikely to be able to recruit Europe as a trading ally to replace the US. China's strong alliance with Russia will make any trade pact with Europe highly unlikely, or very narrow in scope. China and Kenya recently announced they had upgraded ties to a new level yesterday. We had President William Ruto at a state visit to China, which led to the inking of 24 memoranda of understanding to strengthen bilateral ties and aimed at bolstering a myriad of sectors. China pivots more towards Africa and emerging Asia. Europe will hold its nose and do a deal with Trump. We will see US tariffs drop after 120 days or so to more manageable levels after negotiations, but still higher than what we had in the Biden era. UK retail sales unexpectedly rose 0.4% in March, boosted by increasing sales in clothing and outdoor shops. Monthly data showed that the volume of goods bought exceeded expectations of a 0.4% contraction. Apple is shifting assembly of all US-sold iPhones to India as soon as next year, as trade war forces the pivot away from China. The push goes further and faster than investors appreciate, with the goal to source from India all 60 million iPhones sold annually in the US by 2026. Asia stock markets looking up for a second straight week of gains as investors focused on signs that the US and China were prepared to pull back from their trade war. Still in the Asia-Pacific region, South Korea and the United States agreed terms to craft a trade package aimed at removing new US tariffs before July. Well, that's all on this special edition of Global Business Insights. Bye-bye.